You don't have to chase the noise, we already did. We read the data, we watch the movements, we trace the patterns behind every headline. What you get here isn't just information, it's clarity. You don't have to scroll endlessly or compare 1,000 opinions. We do the digging. We face the chaos. We bring you what matters. All you need to do is listen. Profit didn't rise while Bitcoin bled. Accounting did. Today's cover: when profit rises while Bitcoin bleeds, what's real? Is really about a strange split on the same balance sheet. Metaplanet's options premiums soaring, while a Bitcoin marked down turns into a paper wound. And beside it, strategy calmly saying it can survive an $8,000 Bitcoin by turning debt into equity if it has to. So stay with us, because this is the moment the market stops being a chart and becomes a biography. You're going to watch how leverage changes the story people tell themselves, and how profit can be a cash river in one column and a mirage in the next. You can feel the tension already. Prices falling, confidence speaking louder. Prices falling, confidence speaking louder. And somewhere inside that noise, one quiet question forms. What exactly are these firms selling? Bitcoin, exposure, or time? Metaplanet expects profit to climb in 2026 after an options-fueled surge and a Bitcoin paper wound. A business can look stronger and weaker at the same time, depending on which truth you choose to count. Here, we watch Metaplanet forecast higher operating profit even as a falling Bitcoin price turns its balance sheet into a mirror of uncertainty. You feel the tension immediately, don't you? A firm can earn more and still lose. More simply because the world repriced the thing it chose to hold. Metaplanet, the largest Bitcoin treasury company in Japan, is telling you its operating profit should rise by 81% in 2026. That confidence comes after a prior year where operating profit multiplied roughly 17 times, pushed upward by premiums earned from writing options, not from building a new factory, not from discovering a new product, from selling time and volatility to someone else. Look closer and the structure appears. The company held 35,102 Bitcoin, and it reported operating profit of 6.29 billion yen in the prior year. Option writing premiums rose to 7.98 billion yen, up from 691 million yen the year before that. Revenue followed, climbing to 8.9 billion yen. In other words, the cash-like inflow came from a market that was willing to pay for protection, or pay for leverage, or pay for a story about tomorrow. But then the other truth arrived quietly, like gravity. Bitcoin fell from a near $125,000 high to finish the year below $90,000. And with that drop, Metaplanet recorded a non-cash valuation loss of 102.2 billion yen, pulling net income down into a loss of 95 billion yen. Here is the paradox we need you to sit with. Operating profit can rise while net income collapses, because one is about the flow of today's activity, and the other is about the market's latest verdict on what you already own. Micro hook. When a company says non-cash, do you hear not real, or do you hear not settled yet? Metaplanet is still holding more than $2.4 billion worth of Bitcoin, and it expects nearly all of its 2026 revenue to come from those holdings. That sentence matters. It tells you the firm is not merely using Bitcoin as a reserve. It is allowing Bitcoin to become the engine, the identity, and the primary source of future receipt. And yet, the market does not care about identity. It cares about price. With Bitcoin around $68,550, the company is sitting on roughly $1.2 billion in unrealized losses. Not realized, yes, but still a signal, still information, still a reminder that time preference cuts both ways. You can wait out the storm, but you cannot pretend the storm is not there. Microhook. What is a treasury strategy, if not a bet on which kind of uncertainty you can survive? For 2026, the company expects revenue to grow by almost 80% to 16 billion yen, and operating profit to reach 11.4 billion yen. The shares edged up slightly to 326 yen. Though we end in a place that feels uncomfortable, because it is honest. Metaplanet is learning what every Bitcoin holder learns, just at corporate scale. You can harvest premiums from volatility and still be judged by the underlying you chose to marry. If this tension lands in you, hold it for a moment and ask yourself which number you would trust more in your own life, the cash you can touch today, or the value the market might grant you tomorrow. Strategy claims it endures an $8,000 Bitcoin and plans to turn debt into equity. You can feel the tension, can't you? A company builds its identity on Bitcoin, then calmly says it could survive a collapse to $8,000. We are not watching a price claim. We are watching a philosophy of risk try to explain itself in public. Here's the paradox you and I have to hold steady. When leverage works, it looks like brilliance, and when it stops working, it doesn't look like a mistake, it looks like betrayal. Strategy. The Bitcoin treasury firm says it can endure a deep drawdown and still honor what it owes. The firm's message is simple on the surface. Even if Bitcoin fell to $8,000, it believes it would still have enough assets to cover its debt. Not because the debt disappears, but because the Bitcoin pile is large enough that even a harsh repricing still leaves a base layer of value. Strategy holds more Bitcoin than any other publicly traded company, built over years after adopting Bitcoin as a treasury asset in 2020. The scale matters because scale changes the nature of the bet. When you hold hundreds of thousands of Bitcoin, you are no longer just an investor. You become part of the market's plumbing. And the method matters too. Much of this stack was built with borrowed money, a tactic echoed by other firms trying to turn volatility into a ladder. Strategy owes roughly $6 billion in net debt, while holding Bitcoin worth many multiples of that at recent prices. In a rising market, that spread feels like oxygen. But let's ask the uncomfortable question we usually avoid when the candles are green. What happens when the asset you used as the story for your solvency becomes the reason others doubt it? During the bull run, debt-financed Bitcoin purchases were celebrated as conviction. After the fall from peaks above $126,000 toward levels near $60,000, the same structure starts to look like fragility. Not because the company forgot what it believed, but because creditors and counterparties have their own time preference. They do not get paid in conviction. They get paid in cash. Here's a second tension, and it is quieter but sharper. If Strategy ever had to liquidate Bitcoin to meet obligations, the selling itself could pressure the market and worsen the very conditions that forced the sale. A large holder is never just a holder. It is a potential event. Strategy tries to calm that fear by pointing out two things. First, at an $8,000 Bitcoin price, its holdings would still be worth around $6 billion, enough in theory to cover the net debt. Second, the debt does not come due all at once. Maturities are spread across years, reaching out into 2027 and 2032. Time, in other words, is part of the collateral. But time is not free. Time has a price, and that price is refinancing. So Strategy adds another promise. It wants to equitize debt, shifting existing convertible debt into equity rather than issuing more senior debt. Convertible debt is a loan with an escape hatch for lenders, a path where they can swap the obligation for shares if the stock price rises enough. In calm weather, that option is a bridge. In a storm, it can become a mirage. Now we reach the critic's core point, and you can see why it stings. Yes, $8,000 Bitcoin might still cover $6 billion of net debt on paper. But Strategy reportedly paid far more for its Bitcoin, something like $54 billion in total, implying an average cost far above $8,000. A fall that deep would not just reduce wealth. It would repaint the balance sheet in a way that changes how lenders and investors perceive the firm's future choices. Micro hook. Coverage is not the same thing as credibility, is it? One observer argues that cash on hand would only cover a limited stretch of debt service and dividend-like obligations at current rates, while the underlying software business brings in far less than what would be needed to comfortably support the broader capital structure. The critique is not that the company cannot survive a day. It is that it may struggle to roll obligations forward if Bitcoin's price destroys the market's appetite to lend. And this is where the logic of credit becomes brutally human. Traditional lenders do not refinance what they cannot value with confidence. If the primary asset has depreciated sharply, if conversion options are no longer attractive, if credit metrics deteriorate, and if the firm signals it intends to hold Bitcoin long-term, then collateral becomes psychologically illiquid, even if it is technically sellable. In that world, new borrowing would likely demand punishing yields, or fail to clear at all. Microhook. What is a convertible bond worth when the conversion stops being rational? Another voice goes further and reframes the equitizing plan as a transfer mechanism. The claim is that many buyers of Strategy's convertible bonds are not Bitcoin believers, but volatility arbitrators. They are not worshiping the asset. They are pricing the movement. This strategy works through a careful hedge. Funds buy the convertible bond and often short the stock, aiming to profit from the relationship between implied volatility in the bond's embedded option and the actual volatility of the shares. Done well, it can reduce directional exposure while harvesting option misbriefings, collecting interest and benefiting as discounted bonds drift back toward full value as maturity approaches. In a world where Strategy's shares trade high enough, bondholders convert into equity, shorts get closed, debt disappears into stock, and the company avoids cash repayment. It looks elegant. It feels like alchemy. But when the stock falls far below the level where conversion makes sense, the bond stops behaving like a future equity ticket and starts behaving like what it always was underneath, a demand for repayment. Then the question becomes painfully simple. Where does the cash come from? The critic's expectation is dilution. New shares issued, sold into the market, raising cash to meet obligations. In that telling, the magic of the structure is asymmetric. It flatters shareholders in bull markets and taxes them in bear markets. And now we arrive at the real lesson, the one hiding behind all the numbers. Strategy is not merely making a claim about surviving $8,000 Bitcoin. It is asking the market to accept a particular kind of patience, a particular willingness to live through drawdowns without forcing liquidation. That is a social contract, not a spreadsheet. So we sit with the final question, the one that lingers after the arguments fade. When a company says it can endure the worst case, are we hearing strength? Or are we hearing the cost of building a machine that only feels painless when everyone agrees to keep believing at the same time? If you feel that question tightening in your chest, stay with it. It is the kind of thought that tends to return when the room gets quiet. You don't have to chase the noise. We already did. We read the data. We watch the movements. We trace the patterns behind every headline. What you get here isn't just information, it's clarity. You don't have to scroll endlessly or compare 1,000 opinions. We do the digging. We face the chaos. We bring you what matters. All you need to do is listen. Crypto turns red as Bitcoin slips towards $68,000. You can feel it, can't you? The moment the calendar fills with important data, traders stop seeing coins and start seeing clocks. In that tension, the market doesn't just move, it confesses what it was afraid to admit. We are watching a Monday painted in red across crypto, with Bitcoin sliding lower as a dense week of macroeconomic signals approaches. You and we both know what this really means. Positioning is no longer about conviction. It is about surviving uncertainty until the next official sentence lands. Bitcoin trades near $68,200, down close to 3% over the past day, and the broader field falls harder. Ripple, Ethereum, and Dogecoin sink with heavier weight, and most of the largest tokens follow them into the same gravity. Even the privacy coins built for discretion cannot hide from the crowd's mood. Monero and Zcash drop sharply, as if secrecy itself could not protect price from fear. And it is not just the speculative edges. The smart contract complex bleeds too, with a broad index of those platforms falling almost 6%, deepening its year-to-date decline to roughly 28%. When the infrastructure tokens weaken alongside everything else, you are not watching a single story. You are watching liquidity step back. Here's the paradox that matters. Last week's United States inflation data looked soft enough to keep rate cut hopes alive, yet crypto still cannot hold its bounce. That is the market reminding you that good news is only good if it changes behavior, not headlines. Consumer price inflation slowed to about 2.4% year-over-year in January, down from about 2.7% in December. That reinforced expectations for at least 2 rate cuts of about 0.25% each sometime this year. Bond yields responded the way you would expect. The 10-year United States Treasury yield slid to around 4.05%, its lowest since early December. Bitcoin even rallied from roughly $66,800 on Friday to above $70,000 over the weekend. And then it hesitated, and then it slipped. It found the door open, but it did not find the crowd willing to walk through. Ask yourself the uncomfortable question. If the macro backdrop improves, why does the rally still feel fragile? Because demand is not absent, it is selective. The bids are there, but they are cautious, waiting at obvious levels like shoppers who only buy when the discount sign is large enough to justify regret. A chief executive of a regulated exchange in India describes the tone plainly. Risk appetite remains narrow. Cross-currents keep traders defensive, and derivatives positioning looks like deleveraging first and asking questions later. Notice what that implies. When leverage is being unwound, price does not need a new villain. It only needs time. Now we reach the real center of the week. Traders are staring at the minutes from the January central bank meeting and the core personal consumption expenditures price index, the inflation gauge the central bank tends to trust most. Not because these documents are magical, but because they coordinate expectations. They tell the crowd what the crowd is allowed to believe next. Here's the second hook, and it is quieter than the first. What if the market is not trading inflation at all, but trading the central bank's tolerance for inflation? That is why both the month-to-month momentum and the year-over-year trend will be dissected. The numbers are inputs. The policy path is the product. And while crypto watchers fixate on those releases, traditional markets offer a side mirror. A prominent investor known for betting against the Japanese yen has turned bullish, forecasting meaningful yen appreciation, especially against the Swiss franc. That shift matters because correlations are not friendships. They are temporary alliances born from shared positioning. Bitcoin and the yen have recently moved together with an unusually strong positive relationship. So if the yen strengthens, it can become a catalyst for Bitcoin bulls, not through mysticism, but through the mechanics of global risk, funding, and the trades that unwind together. So we sit with a simple deduction. This red screen is not a verdict on crypto's future. It is a snapshot of humans choosing caution ahead of scheduled uncertainty, trimming leverage, and waiting for permission to reprice the world. If you find yourself watching the next data release with more attention than the asset itself, that is not weakness. It is recognition. And it leaves one lingering question in the quiet after the candles move. Are we trading coins? Or are we trading our need to feel certain, when certainty is exactly what the market never promises? BlackRock's digital assets chief warns, leverage-fueled swings are bending Bitcoin's story. You can feel the contradiction, can't you? Bitcoin is being invited into the quiet rooms of institutional portfolios, yet it still moves like a crowded theater where one spark sends everyone running. We are going to trace why that happens, and why the real risk is not price itself, but what price behavior teaches cautious minds to believe. A strange thing is happening in New York. One of the most successful exchange-traded fund launches in modern Wall Street memory is happening alongside a market structure that keeps turning small events into big tremors. You see the tension. BlackRock's Bitcoin fund is built to look familiar, to make access clean and legible. But the underlying arena it points to is still full of leverage, and leverage does not negotiate with patience. Robert Mitchnick, who leads digital assets at BlackRock, puts it plainly. Bitcoin's core idea has not broken. Scarcity still means something. Decentralization still matters. The long arc still points to a monetary asset that lives beyond any single institution's permission. But then you watch the short run, and the story gets noisy. Here is the mechanism, and it is almost embarrassingly human. When traders borrow conviction through derivatives, they turn time into a liability. A small headline arrives, something that should barely nudge a market, and suddenly Bitcoin drops by something like 20%. Not because the world changed that much in an afternoon, but because positions were built on borrowed stability. Microhook. Why does a tiny piece of news feel like an earthquake? Because leverage creates a chain reaction. Liquidations trigger more liquidations. Platforms auto-deleverage. The market is not deciding. In that moment, it is unwinding. And unwinding is not a vote on fundamentals. It is a forced confession about who could not afford to be wrong for even a few hours. Mitchnick's deeper warning is not about a single down day. It is about resemblance. When Bitcoin starts to trade in the public mind, like a leverage version of the Nasdaq, something subtle changes in the adoption calculus. The facts, as he frames them, still point to Bitcoin as a global, scarce, decentralized monetary asset. But the tape, the day-to-day behavior, is telling a different story. And conservative allocators do not just buy assets. They buy narratives that can survive stress without looking unserious. Microhook. What if the real volatility is not in price but in identity? That is why he pushes back on a popular scapegoat. Some want to believe the exchange-traded funds are the source of the turbulence, as if a wave of hedge funds inside these vehicles is constantly yanking the market around. But the redemption behavior he describes does not match that myth. In a tumultuous week, only about 0.2% of the fund redeemed. If large funds were truly stampeding out through the exchange-traded product, the outflows would have been unmistakable. Instead, the evidence of mass liquidation showed up where leverage lives. Perpetual futures and similar platforms built for speed, not steadiness. And now we arrive at the quiet logic underneath all of this. An exchange-traded fund can make access easier. It can widen the doorway, but it cannot change what happens inside the building if the building is wired to amplify panic. The institutional world is not allergic to risk. It is allergic to risk that behaves as if it has no floor, no process, no dignity. Still, Mitchnick is not stepping away. BlackRock's posture remains that digital assets are part of a broader transformation, and that their role is to serve as a bridge between traditional finance and this newer terrain. Not as a hype machine, as infrastructure. So we end in a place that feels almost too simple. Bitcoin's long-term proposition may be intact, yet its short-term behavior can still sabotage the very trust it seeks. And the question waiting in the silence is not whether leverage will create another cascade. It is whether we, watching it happen again and again, will finally admit what the market has been saying all along. Adoption is not blocked by technology. It is blocked by the stories we teach price to tell. If that thought stays with you for a while, you will know you have seen the real headline. And if you're here right now, don't just watch. Talk to us in the chat. Share what you see, what you feel. The algorithm can't read silence. It only reads movement. Every message, every reaction keeps this current alive. Subscribe, share, and let others join this signal. Together, we turn insight into motion. XRP pulls ahead of Bitcoin. And Ethereum, after the crash, revealed the buyers. XRP is moving faster than Bitcoin and Ethereum, and the reason is not mystery, it is behavior. We watch what people did after the drop. They reached for the asset they believed was mispriced, then quietly removed it from the places built for trading. You notice the paradox, don't you? A crash feels like everyone is running away, yet the strongest rallies often begin when the crowd is still describing the fall. Right now, the payments-focused cryptocurrency, XRP, is rising faster than Bitcoin and Ethereum, as investors scan the wreckage for what they think the market punished too harshly. Prices do not heal because time passes. They heal because someone decides the fear was overpriced. Since February 6th, XRP has climbed about 38%, reaching around $1.55 after printing a local low near that date. And in just the last day, it added more than 5%. That is not just motion, it is a statement. Someone is willing to pay up quickly to get size. Bitcoin and Ethereum, by contrast, have gained roughly 15% over the same window, with Bitcoin trading near $69,420 and Ethereum near $2,020. So the gap is real. The question is why this one coin is being chosen as the vehicle for conviction. Here is the first clue, and it is always the first clue in markets: custody. After the crash, there were signs of dip buying on Binance, and the exchange's XRP reserves fell by about 192.37 million XRP, landing near 2.553 billion between February 7th and February 9th. That drop of roughly 7% brought balances to their lowest level since January 2024, and then they steadied. Ask yourself what it means when coins leave an exchange. If you plan to trade, you keep inventory where the trades happen. If you plan to hold, you move it away from the crowd, away from the instant temptation, into quieter hands. This is why analysts often read falling exchange balances as accumulation. Not because it is poetic, but because it matches incentive. Direct custody is a form of commitment. It is the difference between owning something and merely having access to it. And when withdrawals are sudden, the market feels it. Available supply on venues built for quick selling shrinks, and price becomes more sensitive to new demand. The rally does not require a grand story. It only requires fewer coins sitting on the shelf when buyers arrive. We have seen this pattern before. In the final 2 months of 2024, XRP ran sharply from around $0.60 to above $2.40, while exchange balances were sliding faster. History does not repeat as a script, but it often rhymes as structure. Less liquid supply, more urgent bidding. So when you see XRP outrunning Bitcoin and Ethereum after a crash, we do not need to treat it as an anomaly. We can treat it as a confession written in logistics. Who bought where they bought, and whether they intended to sell soon. And now we sit with the quiet implication. If the real signal is not the price spike, but the coins leaving the marketplace, then the next question is not what will happen tomorrow. It is simpler and heavier. When fear returns, will these hands stay steady, Or was the long term only a story they told themselves in the dark? Wall Street stays long on Bitcoin as offshore leverage quietly steps back. You can feel it when a market splits in two, not in headlines but in the small premiums traders are willing to pay for certainty. Here the divide is simple. One side keeps leaning in, the other starts loosening its grip. Look closely, and you will see a widening divergence in global Bitcoin sentiment. United States institutional investors are holding their posture, steady and deliberate, while offshore traders are retreating from positions that once assumed tomorrow would be kinder than today. The clearest confession is written in the futures market. On the Chicago Mercantile Exchange, the familiar arena for hedge funds and institutional desks, traders are still paying extra to stay long Bitcoin. Greg Cipollaro, head of research at New York Digital Investment Group, frames it plainly. The premium remains, but the contrast sharpens when we place it beside derivative offshore, where the same willingness fades. On a 1-month annualized basis, the markup of futures over spot is higher on the Chicago Mercantile Exchange than it is on derivative. That spread is not trivia. It is appetite made measurable. Ask yourself this: when the price is the same, why does conviction cost more in one place than another? Cipollaro's deduction is quiet but cutting. The more pronounced drop offshore suggests reduced desire for leveraged long exposure. And the widening distance between the Chicago Mercantile Exchange basis and the derivative basis becomes a living gauge of geographical risk tolerance, updating in real time as fear and patience trade places. Then came the story people wanted to believe. Earlier this month, Bitcoin fell to $60,000 before rebounding, and some pinned the sell-off on rising concern that quantum computing could undermine cryptographic security. It is a dramatic explanation, and humans love drama because it gives uncertainty a face. But reason asks for alignment between cause and effect. New York Digital Investment Group looked for it, and the numbers refused to cooperate. Consider the strange companionship in price movement. Bitcoin's performance closely tracked publicly traded quantum computing companies such as Ionc Incorporated and D-Wave Quantum Incorporated. If quantum risk were truly pressuring crypto, those stocks should have been rising as Bitcoin fell, benefiting from the very threat the story describes. Instead, they fell together. So we are left with a more ordinary, more honest mechanism, a broader decline in appetite for long-duration, future-driven assets. Not a single monster in the basement, but a room full of people quietly deciding they prefer liquidity to imagination. And here is the second tell, the one most overlooked because it feels too human to be data. Search interest for the phrase quantum computing Bitcoin rises. When the price of Bitcoin rises, that is not fear leading price. That is price leading narrative. People do not search for the reason first. They search for the reason after the market moves, because meaning is often purchased after the fact. So what are we really watching? A world where Wall Street still pays for exposure, while offshore leverage steps back and calls it prudence. A world where stories compete, but basis spreads and correlated declines reveal the simpler truth beneath them. If you sit with this long enough, you may notice your own mind doing what the market does, reaching for a clean explanation when the real driver is time preference shifting under your feet. And once you see that, you start to wonder what other causes were just shadows cast by price. And if you're here right now, don't just watch. Talk to us in the chat. Share what you see, what you feel. The algorithm can't read silence. It only reads movement. Every message, every reaction keeps this current alive. Subscribe, share, and let others join this signal. Together, we turn insight into motion. Bitcoin returns above 70,000 as cooling inflation meets a market still afraid. You can watch price climb and still feel the room tighten We are seeing Bitcoin recover its altitude, yet the crowd's posture stays defensive, and that contrast tells us more than the candles ever could. You saw it happen fast. Bitcoin fell towards $60,000 earlier in the month, and now it has pulled itself back above $70,000, as if the market wanted to prove it can still stand after a hard shove. In the last 24 hours, Bitcoin rose by nearly 5%, and the broader basket of major coins moved even more. But we should not confuse motion with certainty. Sometimes a rebound is just a rearrangement of fear. What changed? Not the technology, not the long-term argument. The spark was a softer inflation reading in the United States, the kind of number that makes people reprice time itself. The Consumer Price Index for January rose 2.4% year over year, slightly below the 2.5% many expected. And when inflation cools, you can feel the next thought form in the market's mind. Maybe interest rate cuts come sooner. Maybe cash stops paying you so much to wait. Maybe the cost of patience falls. Here is the quiet mechanism. Lower interest rates reduce the reward for hiding in safer places. So the appetite for risk returns not because people became brave, but because the alternative became less satisfying. Mid-hook. But tell us this, you can see it, can you not? When the story shifts from inflation to rate cuts, are we buying Bitcoin, or are we buying relief? Even the prediction markets began to lean that way. Traders started assigning higher odds to a rate cut as early as April, and those probabilities climbed within days. Not because anyone discovered a new truth, but because everyone updated their guess about what everyone else will do. Still, we should not let the rally hypnotize us. A rising price can hide a damaged interior. The fear gauge for crypto remains pinned near extreme fear, the kind of reading last associated with the deep bruises of the 2022 bear market, when collapse taught people to doubt their own judgment. It has been stuck there since the beginning of the month, which means the market is climbing while its nerves are still shaking. And then we meet the real confession. Losses were realized. Bitwise observed roughly $8.7 billion in Bitcoin losses taken in the last week, a scale only surpassed by the aftermath of the Three Arrows Capital failure. That is not just selling, that is surrender made visible. Yet surrender has a strange function. When weaker hands sell under stress, the asset does not vanish. It moves. Supply rotates from those who needed certainty today to those willing to hold through uncertainty tomorrow, and historically that transition can precede stabilization. But it never happens instantly. Conviction takes time to absorb panic. Look at the treasuries, the companies that hold Bitcoin on their balance sheets. At one point, they were sitting on more than $21 billion of unrealized losses, a record. With the recovery, that figure fell to about $16.9 billion, not because the past changed, but because the present price rewrote the emotional meaning of the same holdings. Mid-hook. So what are we really watching right now, a new bull run, or simply the market easing off the pressure after a textbook capitulation? Liquidity matters too. Thin weekend volume can lift price more easily, especially when sellers are exhausted. When the crowd has already done its worst, even a small wave of buying can look like a turning tide. But fear remains the main driver, and fear has a habit of turning every rally into an exit door. When people believe lower prices are coming, they treat strength as an opportunity to reduce exposure, not increase it. The market rises, and the market flinches at its own reflection. So we end up here, in the honest tension. A cooler inflation print gives hope. A price rebound gives oxygen. And yet the psychology underneath still whispers that the floor might not hold. If you sit with that contradiction, you start to see the structure. Price is recovering, but trust is not. And maybe that is the real question you will want to carry with you. When the market finally stops fearing the next drop, will it be because conditions improved, or because the fearful already sold and left the room quieter than before? Truth Social and the quiet expansion into crypto exchange traded funds. You can feel the tension here if you look closely. A brand built on politics is asking to become a doorway into digital money, and the question is not whether it can, but what that reveals about how capital follows attention. We are watching Yorkville America Equities, the asset manager building exchange-traded funds tied to President Donald Trump's Truth Social brand, take another step into the cryptocurrency arena. They have filed registration documents for 2 new crypto exchange-traded funds, extending a strategy that treats branding not as decoration, but as distribution. The filing went to the United States Securities and Exchange Commission on Friday, and the intention is simple in structure, complicated in meaning. One product is the Truth Social Bitcoin and Ether exchange-traded fund, designed to give exposure to the 2 largest cryptocurrencies by market capitalization. The other is the Truth Social Chronos Yield Maximizer exchange-traded fund, built around investing in and staking the Chronos token, the native asset of the Crypto.com Chronos blockchain. Here's the first paradox you should sit with. Exchange-traded funds are usually sold as the quiet, regulated wrapper around volatile things. Yet the wrapper is now being shaped by a political identity, as if the label itself were part of the asset. What exactly is the investor buying when the ticker carries a tribe? Both funds still depend on approval from the regulator, but the filings themselves matter. They are a declaration that this politically branded investment effort intends to be more than a headline. And if approval arrives, the funds are expected to launch in partnership with Crypto.com, which would play multiple roles at once: custody of the digital assets, provision of liquidity, and delivery of staking services. Pause with us for a second. When one partner holds the keys, makes the market, and helps generate the yield, where does risk truly live, and who is being paid to carry it? The Chronos-focused product stands out because it reaches beyond passive exposure. Staking rewards are earned by helping secure proof of stake networks such as Chronos, and that converts the fund from a simple mirror of price into a machine that attempts to produce return through protocol participation. In a market still dominated by spot-style exchange-traded funds that mostly sit and hold, this is an attempt to sell not just volatility but income. Second micro hook, because this is where the story sharpens. Yield sounds like comfort, but what is yield in crypto if not uncertainty given a monthly statement? Distribution adds another layer of coordination. Both funds would be distributed through Forest Capital United States, limited liability company, a broker-dealer registered with the regulator, and affiliated with Crypto.com. So the pipeline is being assembled, end-to-end. Brand, product wrapper, custody, liquidity, staking, and distribution, not chaos, integration. This did not begin today. Truth Social signaled its crypto intentions in June of 2025 with a registration statement for a spot Bitcoin exchange-traded fund under the same brand. In July of 2025, it followed with a filing for a blue-chip digital asset exchange-traded fund aimed at a basket of large-cap altcoins. Neither has launched yet, but in markets, repeated filings are a form of persistence. They are the slow work of making an idea administratively real. And then we reach the human problem underneath the paperwork. President Trump is a primary owner of Trump Media and Technology Group, which owns Truth Social, and his personal business ties to crypto have become a political friction point. That relationship is now among the sticking points in advancing the United States Senate's Digital Asset Market Clarity Act, the effort meant to define oversight of United States crypto markets. You see what is happening, don't you? Regulation is being asked to create clarity, while politics keeps reintroducing ambiguity. The market wants rules, the public wants trust, and incentives keep pulling the same people into both the arena and the referee's corridor. If you let this sit for a moment, you may notice the quieter truth. Brands are learning to package access to Bitcoin, Ethereum, and staking networks the way they once packaged access to index funds. And the state is being asked to bless the wrapper without endorsing the identity printed on it. We are blocksonic. We don't predict the market. We read its memory. So when you hear about a Truth Social Bitcoin and Ether fund or a Chronos yield product, maybe the question is not whether these filings succeed. Maybe it is what it says about us that attention now seeks a portfolio, and that portfolios now borrow the language of belonging. What do you think we are really trying to own when we buy the symbol? And if you're here right now, don't just watch. Talk to us in the chat. Share what you see, what you feel. The algorithm can't read silence. It only reads movement. Every message, every reaction keeps this current alive. Subscribe, share, and let others join this signal. Together, we turn insight into motion. Uniswap lifts the CoinDesk 20 as quiet strength spreads across the board. You can feel it when a market stops arguing with itself and starts moving in the same direction. Not because certainty arrived, but because enough people chose a similar story at the same time. We are watching a daily snapshot from CoinDesk indices, and you and I both know what an index really is. It is not a scoreboard. It is a compressed diary of countless decisions, each one made under scarcity, under uncertainty, and under the pressure of time. Right now, the CoinDesk 20 is trading at 1920.47, up 2.0% since 4 post-meridian Eastern Time on Thursday. That rise is not a number first. It is coordination made visible, the kind that happens when buyers become just a little more convinced than sellers are afraid. 18 of the 20 assets are higher. That detail matters because breadth is a confession. When most of the room leans the same way, it tells us the impulse is not isolated to one corner. It is spreading through expectations. And then we see the leaders. Uniswap is up 5.4%, with Bitcoin Cash close behind at 5.30%. Different narratives, different tribes, same outcome for the day. Capital choosing motion over hesitation. Here is the first question to hold in your mind. When a decentralized exchange token leads, what is the market really rewarding, price or permissionlessness? Sometimes the rally is not about a project at all, but about a renewed appetite for trading itself. On the other side, Internet Computer is down 2.1%, and Binance Coin is down 1.1%. Even in an up day, someone must be the place where doubt concentrates. Losses do not always mean failure. Sometimes they simply mean attention moved elsewhere, and attention is the scarcest currency in any market. Another small hook, because it changes how you read the whole page. If 18 rise while 2 fall, are we seeing strength, or are we seeing a temporary agreement that has not yet met its next test? Markets do not eliminate uncertainty. They price it, moment by moment. And remember what the CoinDesk 20 claims to be. Broad-based, traded across multiple platforms, across several regions globally. That is not just distribution. That is a reminder that knowledge is dispersed, and no single desk, no single voice, no single map contains the whole terrain. So we sit with the real lesson. A 2.0% lift, led by Uniswap and echoed by Bitcoin Cash, is not a prophecy. It is a brief alignment of human aims, written in prices before the ink dries. If you found yourself leaning at the contrast between the leaders and the laggards, keep that tension close. Because the next time the room shifts, the question will not be which asset moved first. It will be why we needed the move to believe what we already suspected. Bitcoin's long rally stays fractured until it climbs back above 85,000. A range can feel like stability, but sometimes it is just hesitation wearing a calm face. We walk through why one level near $85,000 has become the market's quiet referendum. and why a drop toward the high 50,000s could paradoxically rebuild the conditions for real buying strength. You can watch a market go silent and mistake it for peace. But silence in price is often a courtroom pause right before the verdict is read. Right now, Bitcoin is moving as if it has forgotten its own story. Not collapsing, not recovering either, just circling between $60,000 and $70,000, as though both buyers and sellers are waiting for someone else to blink first. And here is the uncomfortable deduction. A long trend is not alive because it once rose. It is alive because it can reclaim the levels where confidence broke. That is why Jean-David Pequignot from Deribit points to one line in the sand near $85,000. Until price returns above that region, the longer arc still looks damaged, not because of superstition, but because supply once overwhelmed demand there and has not yet been proven fully absorbed. Ask yourself this: if control has truly shifted back to buyers, why can they not retake the ground where the last retreat began? The market fell beneath $85,000 near the end of January, and since then, the behavior has been telling. You see range trading, you see fatigue, you see a chart that suggests the easiest path is still downward because reclaiming lost territory requires force, and force requires conviction. But conviction does not announce itself with speeches. It shows up when buyers keep buying, even when the market offers them nothing but doubt. That brings us to the next level people keep staring at. $60,000. Not because it is magical, but because humans are not indifferent to round numbers. They anchor, they cluster orders. They build walls of intent at prices that feel simple enough to remember under stress. Historically, that is where large pools of demand have waited. Here's the second question that matters more than any headline. What happens if that psychological floor fails on a closing basis? If $60,000 does not hold, the logic becomes colder and more mechanical. The next place many will look is the 200-week simple moving average, sitting around $58,000. Traders treat it like a final shoreline in a storm, not because it guarantees safety, but because past bear markets have repeatedly washed up near it. Since roughly 2015, that average has acted as a place where pessimism exhausts itself and bargain hunters begin to risk being early. Notice the paradox. A fall toward $58,000 could feel like defeat, yet it could also concentrate attention, reset leverage, and pull in the kind of buyers who only appear when the crowd stops expecting comfort. So when you hear that the rally is broken, do not hear drama. Hear structure. A market is simply people coordinating under uncertainty, and the chart is the record of where they lost coordination and where they might find it again. If you have been wondering what you would need to see to believe again, you already have the map. Reclaim $85,000 to prove strength, or test the high 50,000s to discover whether demand is real or merely hopeful. And if you find yourself quietly arguing with one of those possibilities, that tension is useful. It reveals where your own certainty ends and where the market begins. And if you're here right now, don't just watch. Talk to us in the chat. Share what you see, what you feel. The algorithm can't read silence. It only reads movement. Every message, every reaction keeps this current alive. Subscribe, share, and let others join this signal. Together, we turn insight into motion. Tom Lee's quiet challenge: stop hunting the exact bottom and start seeing the dip. You can spend your whole life trying to catch the lowest tick and still miss the only thing that mattered, whether you understood what the crowd was doing to itself. Here, we watch Thomas Lee step onto a Hong Kong stage and ask you to trade obsession for orientation. You notice the temptation, don't you? When markets fall, the mind starts praying for precision. Lee's message cuts against that instinct. He tells you to stop worshiping the exact low and start looking for entries while crypto moves through what he calls a mini winter. He speaks as the chief investment officer of Fundstrat and as chairman of an Ether treasury firm called Bitmine Immersion. But titles are not the point. The point is the posture he's trying to give you, not the posture of a gambler waiting for permission, but the posture of a buyer who understands that uncertainty is not a glitch. It is the environment. And so he says it plainly. You should be thinking about opportunities here instead of selling. Not because pain is pleasant, because panic is expensive. Now look at what the market has confessed. Bitcoin has taken a drawdown of about 50% from its October record highs, the worst correction since 2022. That kind of move doesn't just erase price. It erases stories. It forces everyone to admit what they were really holding: conviction, leverage, or hope dressed up as strategy. Here is the first tension you need to sit with. If you wait for certainty, you are asking for a price that no longer exists. The bottom, by definition, is only obvious after it has passed. Bitcoin on Wednesday slipped back below $67,000, surrendering part of the rebound from last week's crash lows. It had reversed quickly over the weekend, pushing above $72,000 after trading near $60,000. Then the air cooled again, down about 2.8% over the past 24 hours. Ether followed the same mood, sliding toward $1950, roughly 3% lower. But Lee doesn't treat these numbers as a scoreboard. He treats them as symptoms. He points to volatility in metals, especially gold, as a shock that rippled across asset classes. In late January, he says gold's market capitalization swung by trillions of dollars in a single day. And when that happens, the margin clerk becomes the real central banker. Forced selling shows up where it can, not where it should. Ask yourself a sharper question. When something unrelated breaks, what gets sold first? Usually the thing people own with the weakest hands. Lee's next deduction leans on relative performance. After Bitcoin severely underperformed gold in 2025, he argues the yellow metal has likely topped for this year, and that Bitcoin is positioned to outperform through 2026. You can hear the structure underneath his claim. Capital rotates when the narrative exhausts itself, and exhaustion often arrives disguised as strength. Mid-hook. What if the safe asset is only safe because everyone is already in it? Then he turns to Ether. And here, he uses memory. He notes that repeated 50% drawdowns since 2018 have often been followed by sharp rebounds. Not as a promise, but as a pattern of human behavior. When an asset survives multiple public funerals, it teaches its holders a particular kind of patience, and it teaches its critics a particular kind of regret. He cites market technician Tom DeMark and entertains a specific possibility. Ether may need to briefly dip below $1,800 to form what DeMark calls a perfected bottom before a more sustained recovery. Notice what's happening. Even while advising you not to obsess over the exact low, the conversation can't resist sketching a line in the sand. That's the paradox of forecasting. It tries to map a coastline that only exists because the tide keeps moving. Second mid-hook. Are you buying an asset, or are you buying the comfort of a number? And then we arrive at the uncomfortable part, the part reason insists we include. Forecasts have a track record, and track records are how markets punish charisma. In August 2025, Lee predicted Bitcoin would reach $200,000 by year-end. Instead, Bitcoin peaked around $126,000 in October, then retreated to about $88,500 by December 31st. Later, he said another all-time high could come in January 2026. By January 31st, Bitcoin had fallen to about $78,500. So what do we do with that? We do not sneer. We do not worship. We learn the only lesson that survives contact with reality. Even smart observers are still observers. Prices are not obligated to validate anyone's timeline. And yet his core counsel remains useful precisely because it does not require prophecy. Stop trying to time the perfect bottom. Start thinking in terms of entries, risk, and time preference. The market does not reward the person who guessed the exact moment. It rewards the person who built a process sturdy enough to endure being early, being wrong, and being alone. If this leaves you unsettled, good. That unsettled feeling is the mind noticing it cannot outsource conviction. Sit with that thought for a moment, and if you find yourself forming your own rule for the next drawdown, you'll understand what Lee was really pointing at. We are blocksonic. We don't predict the market. We read its memory. A YouTube star is the next great bank, and the quiet logic behind it. You think the next financial giant must be born in glass towers and boardrooms. But what if the real moat is not marble floors, but attention and trust already earned in the open? Look closely with us, and you will see why a chairman at a crypto treasury firm is pointing not to Wall Street, but to YouTube. Not as a joke, not as spectacle, but as a sober deduction about where the next generation will choose to place its first deposits, its first investments, and eventually its first convictions. In Hong Kong, on a stage built for the future, Thomas Lee laid out a strange-sounding claim that becomes obvious once you follow the incentives. The next defining financial institution for the young may not be a bank that learns entertainment. It may be entertainment that learns banking. He is the chairman of Bitmine Immersion, a firm built around an Ethereum treasury strategy. And he is watching the same thing we are watching, the migration of trust. Not from one asset to another, but from one kind of institution to another. Here is the trigger. Mr. Beast, a video creator, has moved into banking through an agreement to acquire a neobank called Step. Bitmine invested $200 million into Mr. Beast's company, and Lee frames the acquisition as a long-term bet on a single question. How will younger people actually access financial services when they become the economy's center of gravity? Ask yourself this quietly. When a person is 18, where do they already live mentally each day? Inside a legacy brand, or inside a creator's world? Lee's claim is not that these viewers are rich. It is that they are becoming inevitable. Over the next decade, he expects them to participate in a major wealth transfer, the kind that changes which interfaces dominate life. And when wealth moves, the habit of where you look first becomes more valuable than the wealth itself. He compares this potential shift to earlier generational captures. Charles Schwab became a defining guide for baby boomers. BlackRock and Blackstone pulled in the capital and the institutional imagination of Generation X. Robinhood became the familiar doorway for many millennials, each era a different face. Same underlying pattern. The winner becomes the default place where a generation begins. Now the numbers make the argument heavier. Lee points out that Generation Z and Generation Alpha together represented about 120 million people in the United States alone. And Mr. Beast has built an audience of more than 1 billion followers globally. That is not a customer list. It is something more primal, a pre-existing relationship at scale. Mid-hook. What is a bank if not a promise that you will still be there tomorrow? Traditional finance tries to manufacture that promise through regulation, architecture, and legacy. A creator manufactures it through repeated contact, public reputation, and a kind of social accountability that happens in real time. Different tools, same human need. This is where crypto enters, not as a buzzword, but as a consequence. If Step becomes the primary financial platform for these young users, Lee argues that it could also become a major on-ramp into digital assets, because to them digital assets do not feel exotic. They feel native. Not because they are wiser, but because they were raised inside the interface. Mid-hook. And what happens when the first bank you trust is also the first place you learn what money can be? In that world, Bitmine's investment is not merely a bet on a personality. It is a bet on distribution, on the place where financial identity forms. When you control the first doorway, you influence what the room contains.